Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Hope everyone had a good holiday season, New Year, and all that. I guess last week Joe had been running the meeting, and I guess there's confusion with that. So we're back to normal. I won't go on leave too much on Wednesdays in the future. So so we'll get started today. The agenda today, we'll do the market update. Earnings season has kicked off. I mean, the big earnings, start rolling out on Friday with the banks, but, the pre-runners have started. So we'll go through, ones that have populated so far. And Joe's got some charts that we'll go through. So that's what we'll do today. And we'll get started here. All right. Okay, so overall indices, I think the last time I talked to you guys was for Christmas. And we had basically said we thought we'd be range bound, in our for the SPX between 42 and 38, and that pretty much held. We're still in that range. Things have transitioned to 8. They've been in there a while. We'll go in and analyze Russell, and S&P 500 for state modeling here in a few. Overall, the pie, we have crossed over. Bullish has gone above the bearish here. So we'll go through and analyze that also. A lot of volatility in the bond market. Those have all popped up in the 7. They were in 8. And the dollar's been pretty weak also. So obviously, when oil and the dollar are dropping, that is good for the markets overall. So let's go and look at the market pulse first. So you can see here, we peaked around 45 for the state 8s up here. A lot lower than what we've been seeing in the past. This is kind of like last time around here. This is up in the 50s. So, didn't get a huge drop down. And that was really that 3,800 and on the S&P, that support held, and the 1,700 on the Russell held also. So we've had a pretty quick drop down here. From the 40s, now we're down to around 31. And, I wanted to kind of point out a couple of things. So normally when we've been having these drops, I know it's a lot of lines. So here's the 7s. You can see the 7s really, pop up here, and usually, they, drop pretty low here. The one thing I want to point out, the 5s haven't dropped as much as before. They're still kind of elevated. We're around 10% here on the 5s. You can see for the low end of this short-term move. So that's definitely a big change from what we've been seeing. Here we got 5s 26 and dropped down below 10, kind of flatlined here on the big down move, and they were pretty much all the way down. So we're always looking for these 5s transitioning to 1s and things like that. So little different from where we've been as far as the state 5s there. So if I pull that out, just do the 1s, the 1s are still pretty elevated too. You can see up here around 16. So, we've had we had a big drop with the 8. I mean, big pickup with the 8s here, and that was just mostly 7s. Not a lot of the other ones that dropped. So that just tells me, the weaker ones, aren't really holding up, but some of the stronger stocks are showing a little more resilience, through this downturn here. And, really, I think, we've been talking about these key levels, and I think that's really the thing to focus on here. But keep our eye on, the 7 5s, and how, if we start getting transitions from 7 to 5, and then look for that 1 for really follow throughs. But, we're starting off at a lot better place here. When the 8 turned down, overall for the market, market pulse wise. So, the other thing, we didn't really get a big pop up. We kind of been max, this is since like October. We haven't had any one of these real big spikes. It's kind of around 300 type range. So yeah, it's been quite a while since we've had a big spike, and we've had lulls here. This is July basically to like, that's like a month, but now, we're talking quarter basically where we haven't had a big spike here. So, is that foretelling? Hard to say. Excuse me. But obviously, always keep your eye on it. Still not getting new highs because, we're not getting things in state 1, not nearly enough. So that's kind of the quick down and dirty on the market pulse. So I'll go through the overall bullish bearish here. Okay, so we peaked out here, obviously lower than most of the other ones in the past year. Up here we're getting like 80, high 80s, got up to 90 here. So we only got up to 65 here. So not typical for, last year's type of moves, 80 there basically. So a muted kind of downturn here, didn't make new lows for any of the indices, and the important supports held. So really, I think, going into this, next, earnings season is really going to basically tell us where things are going overall for the market, because we're kind of getting at a crossroads. Basically, I'll pull up this one first instead of going to the modeling. This will kind of outline everything. So this is the 3,800 that we had talked about, that the top side is the 42. So we'd talked, before the break, we thought this would hold. So basically it tested a bunch of times and held up. So now, kind of the big thing that we need to, focus on going into this new year. Let me pull back here. This is our trend line, that started basically a year ago. So, that's been pretty much to the top. So right now it's pretty close to right on the 200-day. So just call it 4,000 right now. So that's the top end that, we have to watch for, breakout above. And obviously the one below is at 3,800. And I'll annotate that here closer on the chart. So we're kind of getting, this downtrend going here, and these two are going to, pretty much meet at some point here in the fairly near future. So, my idea is that, okay, we got earnings coming up, are we going to pop above here, or are earnings going to be, bad? We're going to drop below this level. So seems like, just the market pulse, the higher state 5s, seems like, the market's kind of at this point pricing in, continued bullish moves through earnings. That's what typically happens. We haven't seen too many quarters with, the market really going bad during earnings. Probably only 2 or 3 in the last, 4 or 5 years. So, I think that's what kind of has been priced in right now. But really, it's just this key level, 4,000. Then, but obviously above that's at 4,200. But this is that key trend line. That's where I'd focus everything. And then, the support down below is at 3,800. Obviously held very well there over the break. So, and if we
Hey, Josh.
Yep. Sure.
This is Dave. I hope you don't mind me interrupting, but you're right there
No.
on the chart that I'd like to actually see. Can you leave your trend line up there and pull back to the like 2008, like 15 years? What I'm trying to establish here is like the pre-COVID trend line. Put that in, and this is what I do. And I look at that very same chart that you're looking at, but I look at it from this perspective. I take the trend from like 2008, or when the bottom of that long, pretty gradual, very tight sloping curve is, it comes right up to where the pandemic starts. So I draw that 10 line, and then I extend
From
that
where?
through from back in 2009, when it's the bottom of, just do your best fit to that long, pretty steady trend.
You're talking about at the very bottom here?
Yeah, right.
Somewhere?
Go from there as your start point, but put the end point in just before the pandemic starts, just before 2020.
Okay.
Now go up to where just before the pandemic started, where
There.
you see it diverge a little higher, a little higher, a little higher on kind of like on where the price is, a little higher yet even.
Like here?
Okay, mine is a little higher, but leave that there and just extend that line through like the end of this month or something.
Mm-hmm.
And the findings are exactly what you just said. Is the convergence of those two lines is about it at the end of this month, at February, and that's when the next FOMC actual rate change is, and that's when the big week of earnings comes out with the major tech companies.
Yeah,
that's what we're kind of like right in the middle of that coil up, and it's like approaching quick. And I agree with you. It's like we're almost there, and don't be surprised if there's a huge move coming up one way or the other.
Yeah. If you do like a kind of middle of the trend line, that can kind of be right where it's at there, I think, if you're not going off the lows, obviously. But yeah, I mean, it's like what's that shape, Joe? You're more into these like descending triangle or something like that, but
I think it's not a descending necessarily, because the long term is going up, but the short term is going down. So it's a kind of like equal triangle, or there's a name for it, but that's not it.
Yeah, right.
But we're right at where it's supposed to end. So be advised. Anyway, sorry, I wanted to catch you while you were on that chart. I'll be quiet now. Thanks.
Yeah, Joe, did you have a comment?
No, it's just that sometimes, and I'm not sure about a trend line that goes back this far.
Right.
There's a thought that if you get into these lines, into the end of the convergence of the lines, if you go too far into that cone, that oftentimes the move itself is muted if you get too far into the end. But
I agree with you, Joe. I look at this analysis for several reasons. It gives me what the SPX trend was while we were in low interest rates, like around the one that the Fed wants to get back to. It was up until the pandemic started. Then the pandemic trend, you can see that. Now the post-pandemic, I don't know what you want to call that, is depression. Is the other trend line. So those are the three major trends I'm looking at: pre-pandemic, during pandemic, and now post-pandemic. And you see them pretty well defined in that one view that far back, which is why I go that far back, Joe.
Yeah. Okay. Thanks, Dave. This quick view of the modeling. We are in state 8, so we have 13 of 29 days. Didn't really get down to where we normally do. So not following the typical pattern at this point. We had a little dip, didn't get quite down there. And that's really just, you can see here on the left, the low 3764, and that's our 3,800, which really, provided the support throughout this move here so far. Couldn't really break that. Tried, obviously. And, from there, just, okay, are we gonna, continue up higher? Obviously, your next level is gonna be what we had talked about, that the 200-day SMA and our downtrend line is the 4,000. So really, it's well captured here also, but it's a lot easier to see on the chart. We got a 4,000 and we got a 3,800. So that's our range that we've been in for, well, at least the 3,800. The range is 42 to 38, but that trend line has just been going down and down. So, and that's been the top of this. So it's been descending. So really, it's just this is kind of the key levels. Same thing, just on the modeling chart, which does a really good job of pulling these out without all my blabbering. So it's good. All right, let's look at Russell. Similar type of chart. 16 days in, of 28. Had a little push down, but obviously ran into 1,700 support, which has been really strong. And it's been raising back up. Obviously, the top end of our range is 19, but you can kind of use this 1850 as resistance to the upside. Kind of in the middle of the range, or 19 to 17, but that 17, it didn't even get tested. 1722. So, the last move, whereas, the SPX, the low end, got breached a few times, but, held. This one didn't get pushed through. So, we'll just have to wait and see, if we can break through. Obviously, be very bullish, and kind of where we're at, and type of thing. We got, the 200 days been pretty good for the Russell, as tops this year. It's broken through more so than SPX, but still been pretty good. So that level is at 1832. I don't even know where we're at right now. So we're right on it right now. But that's broken through a little bit more. I think the more important thing is the levels I talked about. So the 19, and I'll pull that up, be able to see 19, and then down here is the 17. That's our ranges. Oh, we had that one false breakout, but it didn't breach at 200. But here, it did breach 200, and but didn't get really above that 1900. So another type thing. 19, 17, still range bound. I mean, it's been pretty much like May, since May. Been here with one false breakout here, but pretty much been range bound. Nothing going. So like we were talking about with Dave here, I think coming up this earnings season, it's going to either have us driving higher or lower, and that's kind of my analysis on that. Any questions, comments on overall market there? I'll go
Hey,
through
Josh, it's
some of the
Lee.
other stuff. Yep. Hey, Lee.
Hey, so everything that I'm watching or listening to, earnings are supposed to be adjusted down. They have been a lot projected. And some are saying earnings will even project down or will continue to decline, particularly through this earnings season.
Right.
How does that tie into with the earnings moving down? And if earnings are the real value of a company, then where does that make any I would project things to go down, but
Right.
everything's in a state 8 now. So what are we saying?
About half of them are. I think when they revise down, it gets priced in, right? So then what really matters is not so much, okay, they beat or but their forward guidance that really drives the future move. So I think, what companies are saying after their earnings, and even, if they're revised down some, they'll still beat, because they revised lower than what they expect. So it'll
Mhm.
still say, oh, we beat, but, the forward guidance, if that's starts, like wholesale being lower than what was expected, that'll really drive the market down. I think, small revisions lower. I haven't seen too much overall, like those, found a few things, but overall S&P earnings, I haven't seen anything like, okay, I've seen there's been a lot of revisions down, but it hasn't really, driven the market down as much as it should, I think, but, I don't know. I mean, that's kind of my 2 cents on there.
Josh,
Yeah.
a couple things I might just add.
Yeah.
I don't think there's been a whole lot of revisions, since the new year. But going back to December, and Lee, thanks for the comment. I think it's maybe Morgan Stanley and J.P. Morgan. They're looking at S&P earnings south of $200 in 2023, but that's way below consensus. I mean, I think for 2022, we're supposed to come in around 220 for the year for the S&P 500. I think the range at this point for 23 is around 190 to 225, and they've been working their way down. But the last set of earnings, according to Refinitiv, who we reference from time to time, the earnings that came out in the past quarter exceeded the expectations. I think in 70% of the announcements, the norm is somewhere in the 65, 67% range, and we exceeded. So, I mean, the market obviously has been going down for a year. We've had earnings compression, and kind of, all your points. I think we start to get these earnings in earnest, and especially the banks. I'm sure you're going to mention that, starting on Friday. I think it's really, really important to see the reaction of the market to those earnings more than the earnings themselves, because, there's so many damn numbers in these earnings releases.
Mhm.
So I think 3 or 4 of the big banks have earnings Friday. Let's see how the market reacts. I think there's kind of a 10% range, in this 190 to 220 for earnings for 2023. Lee, as we see revisions come in, we'll send them out. But the consensus seems to be higher than the J.P. Morgan Stanley 190 200 range. Seems to be more in that 200 225 range.
Right.
Yeah,
Right.
Joe, can I comment on that too?
Yeah.
When you talk about earnings expectations or meet or beat, well, are you talking about the earnings estimates from the financial analysts, and I put a question mark after that, and pundits, or are you talking about what the actual companies are expecting to do? And we don't know what they're expecting to do till they announce and on their earnings reports, right?
Yeah,
So,
that's a very good question, Dave. It's the analysts' expectations that they are measuring, that from, and they've been doing it for a long time. I think Josh and I have talked about this before. We'll make sure, we get one of those sheets out to everybody, because they really get into the weeds, with a lot of analysis. So, but it's the analysts' expectations that they have,
right.
been measuring for many, many years.
Yeah, I agree with you, and I think that there's probably some seasonality to a bias to what those analysts say. The old sell in May and go away kind of thing is like everybody's prepping for the fourth quarter already in the second end of the second toward the third quarter, right? So,
Yep.
is there some bias by that whole community to to have a good fourth quarter. And if you do that, because that makes their end of year projections turn out better if you get the last quarter right. So anyway, there's a, if you will, what are we talking about here? We're talking about sentiment, right? Sentiment by the analysts and the market and all of us participants. So it's an interesting thing to watch. But when the earnings report comes out, the companies that did well last earnings season all meet or beat expectations and guided higher. And if they didn't guide higher, if they guided lower, even if they meet and beat, they didn't do well. So what's important? Earnings are important, but it's the future forward earnings that most I think most people are more sensitive to than what you did last. What have you done for me lately doesn't matter as much as what you're going to do for me for any dollars that I'm going to invest now, for example.
Agreed.
So anyway, sorry, I didn't mean to beat that to death, but I think there's a good reason to actually listen to a few of the earnings reports all the way through for some of the key companies that might represent what you hold in your portfolio, to actually get a feel for what the company is how they feel towards the future. And you can kind of get that from their voice, their inflections or whatever, but you don't get it from reading the analyst synopsis of whatever the company just said, because they are already biased on what they're going to report, in my opinion. So, interesting. It'll be interesting.
Yeah, and Dave, I seldom listen to those reports, but I got to tell you, when I do, similar to the Jerome Powell speeches, more often than not, really get a lot out of it.
All right.
Oh,
Yeah,
you
good
got-
comments.
Hey, Joe.
Yep.
This is
Sudhir?
Sudhir.
Yes. Hey, Sudhir.
Hey, is there anywhere on Delphian that gives you aggregate S&P 500 earnings for, let's say, the current, let's say earnings reported in the fourth quarter, because, we're just starting the reporting period for first quarter. Is there anywhere that gives you the aggregate of earnings of all those 500 companies?
Not on our platform. Hey, Josh, can I share
Yeah.
for a second?
Yeah.
Let me see. Do I? Okay. I pulled up something. Here is Ed Yardini. I mean, I've mentioned him before, but this
Yeah, I
is
follow
something
him. He's pretty good.
Yeah, and I mean, you talk about history, and we're talking about earnings driving things, and here's one of his sheets where on the left side he's got the aggregate for the S&P, his estimates versus the analyst consensus, and I mean we've gone. I mean, corporate America's making a hell of a lot of money. You look at the 2009 levels where it's $60 for the S&P 500, and here we are in 2022. Banging up, 215, 220 with 225 expected next year. So we don't have something like this currently on the site, Sudhir, but, here's, one of the resources that I tap into from time to time.
Yeah, that's fascinating. I'll have to look that up. So that also clears up one other thing. I always wondered, when they say 2022 earnings, Q4 is showing estimates, so they must mean the earnings reported in Q1 23, they're calling Q4. Correct?
Yeah,
Otherwise, see where it says 2022 Q4, 5450E, that wouldn't be an estimate if it was the actual earnings reported in Q4 for Q3 quarter.
Well, I don't think this probably didn't come out.
Yeah, this is maybe a week old, something like that, and maybe there were still a few left. So I think that's why he's still got E as opposed to A.
So when they say Q4, is that reported in Q4, or is that the earnings for Q4 reported in Q1? What is the exact time?
Yeah, I mean, it's a fair question. I'm not going to pretend I know for sure.
Okay.
I think it is the earnings reported in Q4.
Okay. That's very interesting.
Yeah, well, you can see it kind of like it peaked there in Q2, right? Pretty much
A
gone
little
straight
bit,
up,
yeah.
obviously outside of the COVID, but just slowly grinding. And I got a 53 there for Q1 and then, have it go back up after that. So that's a Fed pivot, uh, estimates there, I think, right?
But
Yeah.
they're saying that with inflation above 6, the PE historically has been 15. And so if you take 2023 estimated earnings of 15, I'm sorry, 225 times 15 gives you an S&P of 3375, and we're at 3952.
Yeah, and yeah, that's part of the fun, right?
Yeah, so that seems to me, based on even forward earnings, that we might be overvalued.
Yeah, I agree with that.
Mm-hmm.
Because the whole thing is that with the FOMC raising rates, market multiples have to come down, right? And the S&P multiple was, when rates were at 0, everybody was fine with an S&P 500 multiple of 20, 25 or something like that. Now the commentary I'm hearing is that with interest rates higher, that multiple has to be lower.
I would agree with that. I mean, people can get
Yeah.
yield, risk-free yield, outside of here. They're not going to be paying high premiums for, a 1.8% yield on S&P or something like that. When they
Yeah,
can
I mean,
get
the 2
core
years at
risk-free.
4%.
Yeah,
So
Josh,
makes sense.
I'll turn it back over to you, Josh. But
Okay.
The screen, as I mentioned, you just Google Ed Yardini, and he puts out a lot of information pretty frequently, and he's been around a long time.
thanks.
Okay, just kind of quick hitters here. Obviously, the next Fed meeting's 1 Feb. So right now, priced in for a quarter, 77%. It's changed a lot over the last month, but been pretty stable past week or so. So once it's over 80, if it's over 80 going into the meeting, it's a lock. So this one, keep your eye on it. Still got a couple weeks left here. The balance sheet, they actually been doing stuff since we've been taking a break here. So, our last meeting, we were right around, I think that's the last one we looked at, 85. So they're dropping, that's like 20 bill, 10 billion. That's good 50 billion right there. So they are, continuing. So, perspective wise, we always talk about where we ran into liquidity crunch here, and that was like a 15% drop. So that 15% drop would be, let me annotate here, right around this area. That's where, at least the last time, we had those overnight rates go crazy. I did have some more kind of charts on liquidity that I'll show you, but always keep this is the most interesting thing to me, obviously, is we talked about M2 contracting last year, and so obviously this is going to be a very important thing as they pull liquidity out of the system, to watch for. My two big concerns are for the market downside are, liquidity crisis and, some kind of war. So rates, obviously everything's inverted. That was a year ago, sorry. I think thing is the 10 years inverted to everything, including 30. So, your 1 month, your highest right now is the 6 month at 4.842. Wow. You get a 1 year nice return there. You haven't seen these in a long time. Even 2 year, 426, here we're 362. This has been very volatile and I think it'll continue to be. We've had big spikes, big drops. We got back up almost 3.9, just swooped down to 3.5. That's kind of, we talked about that like 3.5 is kind of like the line in the sand where it usually bounces up above that. So we're right on that right now, that area. But obviously still inverted. Seems like the curve's shifting, a little bit kind of that way. I think before, the tops were right, the 1 year was the top here. 2 year was higher, but seems like it's shifting a little. Okay, big economic news, is tomorrow, obviously inflation, CPI. So that could be a market mover. Obviously, if it surprises higher, that would be real bad. But obviously expectation is, we drop some. Seems like, outside of eggs, which I was talking about with Joe, which, doubled since last month, it seems like other prices are, kind of moderating. All right, a couple things, always looking out for liquidity stuff. So this strains on a credit market. So this is troubled debt, since last November. And I think this was through November, so 1 year. So distressed bonds and loans has gone up pretty substantially since that time. So just kind of one point on.
You think that'll make a difference on the bank earnings that come out tomorrow? Just
On the what? The
on
bank
the
earnings?
bank earnings that are going to come out tomorrow.
Um,
It's an opinion kind of question. I don't know there's any analysis you can do, but
yeah, I haven't
just curious.
analyzed that. I know they have a big, they allocate a lot of money to reserves for bad debt, but
Mhm.
I couldn't say one way or the other. It's just distress. It's not defaulted, but they're in trouble. And I think that that kind of chart, a lot of these things are tied to a lot of this debt can be tied to like the LIBOR rate, it could be variable rate stuff, and like they're in trouble. They thought rates would stay low forever, but things start spiking up. If they're I mean, if their loan is tied to like the 6 month, the 6 month plus 0.5 or something, now they're paying 5.3, like that's serious trouble. So just depending how the loans are structured, but I would imagine a lot of these with like the floating variable type loans, but building is not good. This is a reverse repo. You can see here it's just been building and building, and that's where we ran into that like overnight lending rate, spiked to like 12% back in 19. So the same type of thing. So this has been building. I haven't seen since the beginning of the year, but obviously, concerning, seeing that type of stuff when we're talking about liquidity problem. This is another just interesting one, savings rate, personal savings rate. And I don't know if that, I just found this on the side. I didn't make this. But obviously personal savings rate down to 2.2. So I think the all-time low on this is back here, 2.1. So we're near that, but you had a huge spike up here. And this was like the COVID payments that were going out, and it's been straight down since then. And that's really just inflation eating away at people's consumable money. Especially like lower middle income people. So that one was interesting. Just wanted to pull it out. last one. This one is pretty interesting. I just want to throw it out there. So this is reserve balances at US banks, and I'm not sure where they got this. And then they just lined it up to basically the market cap of the US equities and pretty much lined up pretty well. I can't verify this, but it was just kind of interesting. So I don't know if they're, saying, what the thesis here is, but it was definitely interesting. I'd have to think about it more, but that was
It
it.
looks like the S&P chart.
Yeah.
Josh.
Yeah.
Or the NASDAQ, damn.
Yeah, I'm sure you can find this on the Fed there, the reserve balance at banks. Yeah. I'm sure it's in that Fred stack of, this wormholes that you got to go find it at. But interesting, nonetheless. That was it. I think that was it for market overall. Any questions, comments? No? All right. Well, I think Joe had some charts. We'll
Hey,
run through
Josh.
those. Yep.
Oh, hey, this is Mark from Chicago. Hey, just on a note, I was in this little meeting yesterday with these Fidelity economists, and they see inflation to 4% by the end of the year, which I thought was
Yeah.
interesting. So, I mean, I generally think that's kind of optimistic, but whatever, just throw that out there.
Yeah. Yeah. I mean, I feel like
Was that core? Which inflation was that, by the way? Core or which part of inflation?
Just the number that comes out tomorrow, which is what, CPI generally. Yeah. that's
Okay,
what-
got it. Thanks.
yeah, I mean, my general feeling is I think inflation is going down, and I think a lot of that's driven by the M2. So if they keep, the Fed keeps doing what they're doing, I think inflation will come down. I don't think it's, I don't think the interest rates really, I mean, that stops, economic activity. I think it's more about the money supply than, the rates, just stopping economic activity. They're slowing it down. The M2 is kind of the key, I think, for, the inflation game. So thanks, Mark. Oh, I forgot to say, we had a couple earnings trades. Let me pull those up real quick. I almost forgot before you go, Joe. It'll only take a minute.
Ah, take your time.
All right, so we've had bullish pre-runners. That's it so far that have populated. So we got 4. We got 2 active. So these popped up on the 10th. Obviously, this one's doing well. Both of them are up right now. The other ones, 4 of them so far, they've all hit their targets. So so far so good. This is like a day, it's like a week. This one's longer. The Travelers that was the first one, Travelers, but it did, close out the 6th. So so far so good. And just kind of like it's like almost every time, I close those other charts, but as soon as we put out the earnings plan, that's the interim low is close by, and it it'll rally up into the earnings season. All right, this isn't working. So we put out the plan. I'm getting nothing here. Sorry. Anyways, we put out the plan December 15th, and pretty much within the next week and a half it kind of bottomed, and then we get the run up. So 4-0 so far, and looking good for these 2 so far. What did obviously, all right, it sucks. Continue to monitor. That's the only trades that have been going. We've had a lot of I track these every day, so we've had a lot of estimated too. So more estimated than confirmed. You can see there are lots estimated, but that's the nature of it right now. But, so far so good. That's all I want to, that's all I want to cover on that. So I'll turn it over to you, Joe.
All right, Josh, thanks.
Mhm.
Let's see, just pull up, I'll pull up a couple charts here. I like to focus on a few that, are, the important weighted stocks and the various averages, Amazon being one of them. Talked about this one before. I mean, it's been in state aid forever. And just as a reminder, I think it's one really to try to keep an eye on. I think I've got this. Okay, so there's the full chart going back to pre-COVID. I was just looking to see whether it really is a good leading state chart. And, it obviously had a great run, in state one coming out of the COVID lows. Prior to that, it was, I guess in that death spiral that Josh likes to refer to, the 8787 before it took off. We've had a couple monster state eights, over the last year and a half. And so, actually over the last year. So I just think that, keeping an eye on this. I don't know what it's going to take for this thing to roll into a state one. We've had a little bit of a rally recently, but, down 30%, 4 times the average period of time. I think just wanted to keep an eye on. So that's Amazon. Apple is always, and I'm getting mixed opinions in terms of when the earnings come out. I mean, we're showing 126. I see some other sites that say 126, and then I checked Wall Street Horizons, and they've got a confirmed release date of February 2nd. So I'm not quite sure exactly when the earnings come out in Apple, but like a lot of these big stocks, and obviously Amazon, exceeded target 3 by incalculable percentage. But some of these other big stocks, here's Apple's a perfect example. T2 is met. We're banging up against the end of the average period of time at 24 days versus 30.
Having a nice day.
Okay, thank you. So from a time perspective, I think that it'll be interesting to see if this thing also is going to turn around and maybe jump into a bullish state. But we've been in state aid for quite some time. Here's Microsoft, and Microsoft earnings are confirmed for the 24th. As Josh frequently points out, these targets, can really be something. You can see very quickly Microsoft, shot down to, the target 3 level at 220 and has bounced from there. Really just getting started in terms of average period of time in state aid here, but we've already reached target 3. So let me see. There's Microsoft going back to the pre-COVID also. So had a pretty significant pullback, and I think I got one more individually. Yeah, Google met T2, talking about early February earnings. That's not the longer term chart, but here we are in terms of COVID. Gives you a sense for how far it's pulled back, which is, again, awful significant. So, because these are, big weights in the averages, I like to keep an eye on them. And, all have earnings coming up in the next couple weeks to a month for sure. So the big stocks, in terms of the ETFs, we've now got 4 of the 11 ETFs in state 1. 3 of those 4 have happened either in the last day or the last 3 days. I think it's, let's see, materials here. And, some of these have actually held up pretty well. But again, there's the chart going back to the COVID lows. All of these things basically bottom, like Josh was showing in the transitions, where I guess it was state 8, kind of topped out in the 60+% back in late September, early October, when we had basically the market lows. All of these indexes or ETFs have rallied 15 to 20% coming off of those September, October lows. So I think, keeping an eye on all four will be, worthwhile. They're the materials that have done pretty well, but just rolled into state one last night. Another one are the industrials. This one actually, and there's the longer term chart going back to the COVID lows. Again, pretty surprised to me how strong this group is, but indeed they are. They've been in state one here for a little while, close to a month, coming up against, what may be running out of steam, with a 36-day average, but another one to keep an eye on. And then the two others that have, rolled into state one in the last couple of days. I think this is the consumer staples. You can see they've also held up very, very well, about 20% off the September lows. And just, I think it was 3 days ago, they rolled into, state one. So we keep an eye on them. And then lastly, the utilities. So, they're kind of a slow and steady, maybe not offering, too much in terms of insights, but it's the materials, the industrials, consumer staples, and utilities. 4 of the 11 are in state one, and 3 of them just in the last couple of days. So, bear watching. I don't have the financials pulled up, but it'll be interesting to see after our bank announcements on Friday and the reaction to those earnings, exactly how the XLF responds. So, and then as Josh pointed out, we went about 3 weeks with really not much happening in terms of the pie. It was pretty stagnant with the green staying around the 30-35%, but we got a pretty good bounce last week. So we'll see if that continues. I think tomorrow morning, as Josh said, I think it'd be a shock if the inflation number isn't down as everybody expects tomorrow. They're looking for, I think, 6.5%. We then go pretty quiet with numbers until I think it's next Wednesday when we get into the producer price indexes. So the market's going to have to, I think, act on its own. So that is just one other thing. AAII, which I was expecting that last week of December for the bulls to even drop below that December 20th level of 20%, but that didn't happen. They increased a little bit. They dropped down back to the December 21st low last week, but really what happened was, the neutrals expanded with the bearish increasing, not at all, but actually decreasing a little bit. So, try to keep an eye on that from time to time as well. Sentiment. I think it is Friday that we get the Michigan consumer sentiment numbers as well. So just a couple things that I'm watching. Certainly open to all comments. Appreciate the participation, and thank you. Josh, back to you.
Yeah, thanks, Joe. Does anyone have any questions or comments before we close up here?
This is Dave. I just went back to the Amazon website to look to see if they publish their next quarter earnings, and they don't, by the way. But a year ago, it was on the February the 3rd. But on their own website, they don't have a date for their Q4 earnings that's coming up.
Yeah, and the one I have is 2/2, Dave, but not confirmed yet.
Yeah, I don't know. They don't always hold to what they did, kind of like last year. I noticed that I don't think it's been a while since I can remember the banks actually coming out on a Friday. It seems to me they're always on a Wednesday or Thursday, usually on a Wednesday with a couple more days left in the week. But today it's like the last day. So if you're going to do an earnings play, you got 1 day of data in the trade if you're going to play an earnings trade in the banks this year. Kind of
I agree with you. Josh and I were talking about that. Friday seemed very odd. And, we're doing, different things behind the scenes, with the website and the platform. And we've been slowed in some progress, over the last month or so for various reasons. But we do have, an awful lot of work and data behind the scenes on earnings date releases. And when we get all of our infrastructure straight, we're going to spend a lot of time on that. So we're going to be able to pinpoint, earnings dates within a day or two for everybody. But we just haven't had a chance to do that yet. But that day of the week, to your point, the days of the week, and then inside of a couple of dates, we've got all that. We just haven't been able to spend the time we want to be able to, release it in an acceptable fashion just yet.
Okay, thanks, Dave. Anyone else?
I just have a real quick question. It's Mark
Yeah,
again.
sure, Mark.
Have those emails been still coming out, like daily trades and
Yeah.
earnings? For some reason, I haven't gotten them. I can get back to you personally. I'll shoot you an email or something.
Yeah, I can check. Sometimes if, I think sometimes if you don't open them up for a while, they put you on like the non-engagement list.
Oh, okay. Yeah, if you can check for me, or if
Yeah.
you want to shoot me an email.
Yeah, I'll research that and let you know.
Thank you. Thanks a
Sure.
lot. Bye.
Okay, anyone else? All right, well, thank you all. We'll do it again next week.
Have a good week, everybody.
Thank you.